I look blurry. Oh, there we go. Hello, everybody. How's it going? I don't like that shade. Hold on, let me put the shade down here. Let's see how this looks. Oh, yeah. Taking away the glare. How's everybody doing? It's been a good few days. Need a little bit more to go right to make it a banner 2024. I am feeling good. Where shall we begin? Might as well start with Nordstrom since that is the topic du jour. Though clearly I have a lot to say about BBIO. I was sick with COVID, as you guys know, a few weeks ago, and I'm totally fine now. It was very minor anyway, but I didn't want to do a BBIO YouTube last week because I woke up at 2 a.m. For the ALNY full data, and I was just too tired to do it. So I never got around to doing one. So I will now go into great detail for the generalist that I am on BBIO and the ALNY full data. But let's do Nordstrom first. Great news this morning from Nordstrom. Okay, now to remind you, I don't own any common in Nordstrom. I had a decent sized common position. I sold it all in the last few weeks, but I have a huge complex position. So it's all call spreads, 1x2 call spreads, and January 2026 butterflies. And the whole time I was betting on a deal that was more than $23 and less than $27. That was kind of the setup. I would have made money even if it was a 22 to 28 deal. But to maximize my money, a 25 deal is where I make the most because I'm short a gazillion 25 calls in January 2025 and January 2026. I'm also short 24 calls in October. Again, 1x2s. In addition, I have lots of regular call spreads on as well. Though all those regular call spreads are 20x22, 21x23, and 20x22.50 in January 26. So as long as the deal is above 23, all the call spreads are going to be in the money. What happened today? Oh, here comes the dog. Sorry, guys. Give me 1 second. Come on. Let's go. Come on. Let's go. Let's go. Let's go. Come on. All right. What happened today? So they announced that they are submitting a $23 bid with the 9.99% shareholder from Mexico, which is a public company. And they have committed financing, equity and debt. The only new debt that's needed is $250 million. They're going to roll over the existing debt, which I didn't know they would be able to do that because I didn't know this would be a change of control or not. And they're also not investment grade rating. So it's my understanding that if it's a change of control or not investment grade rating, then the debt has to be made whole. Clearly that's not true, which is a huge positive for this deal because they have tons of cheap debt that go all the way out to 2044 or something like that. I thought that was the biggest impediment to a deal ever happening, was having to refinance all the debt load. Clearly they don't have to, which is why they probably originally said they were going to make a proposal to buy the company. First thing I did this morning was I looked at the 13D letter that came out today, and I compared it with the 13D letter from 2018. So in 2018, after a very odd year of the family trying to take the company private, on March 5th, the family 13 deed that they were going to pay $50 a share preliminarily. They did not have committed debt financing or equity financing. They had a range of equity that Leonard Green was going to put in. And they said that they only put this $50 bid forward because the special committee urged them to, kind of shit or get off the pot. The stock was trading like 51 or 49, basically where it was trading around the 50. And it was a 25% premium to the unaffected of 40. That same day, so the 13D came out in the after hours in March 5th. The same after hours, the company issued a press release confirming and rejecting the bid, saying it's too low, and that if they do not come up with their bid, they are going to cease negotiating and offering due diligence to the family. Okay. Today's news is so different. Okay. First of all, the letter, the 13D letter, it's like night and day compared to the one in March of 2018. Okay. They have all their financing. They completed all their due diligence. It's a binding bid, basically, subject to definitive documentation with the company. They are the company, by the way, right? They control 41% of the company, Nordstrom and this Mexican department store. The company put out a press release, just like they did last time, but this time not rejecting it. This time saying they confirm they have it, and they will tell you in due course what happens. Okay. It's my belief that this is now 90+% done. They will likely, not certainly, but likely top the bid, give a kiss from the 23. It won't be a huge kiss. My guess is it's somewhere between 23.50 and 24.50. Okay. Certainly not above 25. And the special committee will absolutely bless this deal. Why do I think that? First of all, I do firmly believe that the unaffected is around $17. That was why I structured the position the way I did. I thought that you could make it huge with these 1x2s and the butterflies because you're not going to get a deal above $25. Okay. Second, the industry is a complete mess, right? We saw what happened with Macy's. We see what's happened with Kohl's. Dillard's blew up on the last earnings. The special committee has nothing to stand on to say that this is worth more than $24 a share. Okay. Third, there's going to be a majority of minority vote here. Okay. There's no shenanigans happening. If an activist wanted to come in or people wanted to vote this down, they have the right to do so. They're not going to. No activist is going to come in here and try to squeeze out more money from the Nordstrom family because this is a shitco and it's not worth $24 a share. So your market test today shows you this, right? Stock traded up to 23.50 originally this morning, and now it's trading 22.90. Now, mind you, there's a dividend here that was just paid, and there's like a 3.5 to 4% yield, basically. So the market is telling you right now that it's likely this deal goes through. You can see how the option chains have compressed, though there's still premium at the 25 line in January 25 and January 26. They've come in, right? And some premium is warranted there because the market is going to put some odds that they get more than 25 in this negotiation. But it's trading at the right price, right? Let's say it goes for 24, which I think it probably will. You get the dividend, so it's going to trade very tight once it's announced. So there's still upside. It reminds me a little bit like EDR. You're not going to have massive upside here. 50 cents to $1 probably. Whereas break, I mean, break could be $20, $19 here. I don't think the numbers were substantially that great. The last 2 quarters, I called it Goldilocks for a deal because they didn't change anything material with the company versus when they wanted to do this back in February or March. And that's what you want when you're going through a long process. They just reported last week, so you have no numbers risk here. And I think they're going to wrap this up pretty quickly, right? One really important thing to note is that since they own 41% of the company already, the number of shares outstanding that they don't own is something like 100 million or so. So every dollar in bump is $100 million of cost to them. Okay. This is a giant deal. Okay. This is I can't remember what the 7 billion or 6 billion enterprise value at 23, something like that. I can't remember the exact number. This is not breaking over $100 million. Okay. It's just not. And 100 million gets you to 24. And I just cannot see the special committee rejecting it. Further, if you look at the pattern of last time, they rejected it the same day that they went public with the 13D. That did not happen this time. So I think there'll be a fast negotiation with a kiss. Also note that the Nordstrom family did not say this was their best and final bid at $23. If they really weren't committed to not paying a penny above 23, That would have been in the letter. It would have been a last-ditch effort to get this over the line with the special committee at 23. It does not say that. So I obviously love Nordstrom here with the way I'm positioned. I don't know what I would put on today if I didn't own anything. I probably would sell some small puts, but again, you have a real bad break here, I think, if it doesn't go through. So I would focus maybe on like October 22, 23 call spreads, maybe some January 25, 22, 50, 24 call spreads. Your worst case there is probably a small bump to 23.50 and you don't make a lot of money. I don't love those. Maybe try to get on some April 22, 23 call spreads. Even paying up to 65 cents or something for those call spreads is a pretty good IRR for something that has a very high chance of happening. Plus, you still have some value in the April line if it breaks, because you still have lots of time, obviously. But, I don't know what I'd put on today. Common's probably fine too. But yeah, I'm really, really enthused with Nordstrom. It's playing out exactly how I hoped it would. It's going to be the perfect price. I mean, it could be 25. It ends up going for, which is right on the dot of all my 1x2s and the butterflies. So we'll see. BBIO. I don't even know where to begin here. I know a lot of you follow me on Twitter, so you've heard it over and over and over again the last week. But I could not be more enthused about BBIO here. I don't think I've ever liked it as much as I like it today. Let's just get into it. So as I predicted back in end of June, I did a YouTube on this, though it got hidden by YouTube for a few days, for a day or so, because I had copyright infringement because I had a TV show. I don't even want to say the name of the TV show. I'm scared I'm going to get copyright infringed again in the background. My thesis was that when the ALNY releases their full data set, it's going to show to be inferior to BridgeBio's data set. And what do you know? It's inferior to BridgeBio's data set across all metrics. Okay. I don't need to fully rehash it here, but basically time to separation for either all-cause mortality or first cardiovascular event. For BridgeBio, it was month 3. For mono in ALNY, it was month 7 or 8. Okay. 30-month mortality data for BridgeBio, it was nearly stat sig with a 25% relative risk reduction. For ALNY, it was virtually nil, the 30-month mortality data. Okay. Further, 33 to 36 month endpoint mortality data for ALNY was not stat sig. This will not be in any label. Okay. That up to 42-month OLE is complete bullshit, and that just won't make it into a label. So from a label perspective, you'll have no superior, gotcha moment between the two drugs. Time to when the mortality curve separated, they're about the same. BridgeBio is probably a month earlier versus mono and Acor. Without them changing the endpoint from 30-month to 33 to 36 months, this trial does not read out statistically significant. Okay. Fact. And they had to extend the trial 3 months to be able to show stat sig. Okay. Now there's a lot of confusion on Twitter and some in the KOL community about that. It doesn't matter that it's month 36 versus month 30. It's unequivocal that the ALNY drug works. And because of that, there's no reason to split hairs between month 30 versus month 36 and month 42. Okay. This is false. Okay. The drug definitely works. Nobody denies it. And ALNY has the absolute right to structure their trial any way they want to. They want to run a 60-month trial to show stat sig and mortality. They can do it. Okay. It's not cheating. They're allowed to do all this. But as a clinician or as a patient, if I am in a doctor's office and I'm going to decide between 3 drugs, I am going to try to compare them the best I can, not based on how they structured a trial to hit stat sig, but based on which I think is more efficacious, period. Hard stop, okay? First of all, one of the bull cases on ALNY was that it would be better for sicker patients or separate earlier on for some reason, okay? So people would prefer the ALNY drug because you'll get healthier quicker. We now know definitively this is not true, okay? They'll say it's because the patient population was healthier in their trial versus BridgeBio's trial, and that's why separation occurred later. BridgeBio's trial, while it did enroll sicker patients, it's on the margin sicker patients. The BridgeBio trial just read out 1 year ago, okay? It wasn't 7 years ago when tafamidis read out, okay? Second, they talk about how there was more patients on background therapy, 40% on TAFA versus 20% on TAFA and BridgeBio. Again, I'm not going to go into the weeds here because, quite frankly, even I don't fucking understand the stats behind the weeds, but this is just not true, okay? That's true, the 40 versus 20, but you would see it in the stats of the ALNY drug data. You would have seen significant risk reduction at month 30 still, okay? And you don't. And the most amazing thing is that going into this readout, right, the street was at ALNY getting 6 to 8 billion in peak sales here, okay? And BridgeBio's peak sales were about 1 to 1.5 billion, okay? I believe now, after this readout, BridgeBio will be the dominant market share of ATTR-CM, okay? They should capture, I think, greater than 50% of all new patient prescriptions. And this is key, that is not in anybody's model. There should be at least 10%, if not up to a third of tafamidis patients currently on am I even saying that right? Tafamidis? I hate these words. That's why I just call it Tafa and Acor and Vitri, whatever the hell it is. I think between 10% and 1/3 will cross over from tafamidis to Acor in the first 12 months. Why do I think this? Well, first of all, KOL just talked about this on a call yesterday. He said he's even spoken to his patients already. And he said, and I've said this before in here too, if you're going to the doctor's office, okay, and I say to you, hey, guess what? There's a new drug that was just approved for this indication, this terrible disease you have. Do you want to hear more about it? Yeah, let me hear about it, doc. Well, first of all, it's the exact same MOA and class drug that you're currently on. So we know this has been working for you, or it's not been working for you. So there's no real risk of terrible side effects or whatever. You're already used to this MOA, okay? Okay, that sounds interesting. Well, why would I switch? And it's 2 pills versus 1 pill. 1 pill and 1 pill at night. You know, why would I want to deal with that? Well, what if I were to tell you that it's been proven biologically that this is a 95% stabilizer versus a 60% stabilizer? And I can show you that in this trial they put out that you are getting higher levels of stabilization from this new drug versus the old drug. And while you can't compare trials, I can show you what the curves look like in this trial versus tafamidis. Now you might say, well, look, Matt, if you go back 8 years ago, the tafamidis trial was better than the Acor trial. There was a better relative risk reduction and a larger, a lower HR. Okay, totally different patient populations. Okay, again, in this current trial that just read out from Acor, the placebo group outperformed the TAFA arm in the tafamidis phase 3 trial. People live longer on the placebo group with drop in TAFA than they did in the drug arm 6-7 years ago. So it's very clear that those 2 trials are not comparable. And then you take the biological standpoint of the fact that you know that this drug is more potent. So of course it's going to do better for you in this disease. Now, 2 interesting things I heard yesterday from the KOL. First, he said he asked patients about this already, and most patients says they would switch. And we're not even talking about patients that are not good responders for TAFA. But the most interesting thing he said was this will be approved in November, okay? The ALNY drug won't be approved until probably May or June of next year, okay? He said he would switch all non-responders for TAFA over to ACOR, and it would not be fair to wait for ALNY to be approved because these patients could die. And then he said you'd have to wait years to see if it works on ACOR before you'd switch him to ALNY, okay? He even thinks even after ALNY is approved, you'll probably get 50-50 for second line for ACOR versus Vitry. Okay, so he does not think that ALNY gets all the second line patients once it's approved. He thinks it'll be a split 50-50. Okay, the numbers here are nuts. Okay, TAFA is currently doing run rating $6 billion a year in sales. Okay, if they capture 10% of the TAFA patients in the first 12 months alone, that's $600 million in sales. 10%. Okay. If they capture a third, it's $2 billion. Okay. Priced at the same. They probably priced it a little bit less, is my guess. Okay. So if they price it a little less, what are payers going to think about this? Are you kidding me? Payers will be able to see that time to separation at month 3 is the highest it's ever been in any trial on ATTR-CM. And hospitalizations cost thousands of dollars. Of course, payers would rather you have less hospitalizations for the same price drug. Again, it's hard to compare across trials, but because of the biological nature of the drug, it's reasonable to assume that it is a superior drug. Even if it's just on the margin superior, it's still superior. If you're a patient and you can take this versus taking TAFA, you take it. I take it in a second. Okay, that's my gut check here, right? I'd even pay up for it if I was told I had to pay more money for it. Okay, but there's more. This market grew $2 billion this year or more, almost 100% year-over-year growth, because it's just scratching the surface of how many patients have this disease. It's reasonable to believe that in 2025, the market grows between $2 and $3 billion again. Okay, let's use $2.5 billion just for argument's sake. If you think that ACOR just gets 1/3 of those patients, I think they're going to get more than 50%. Mind you, ALNY won't even be on the market until May or June, halfway through the year. But with a new prescription for a new patient, it's, to me, actually immoral for a doctor to prescribe tafamidis over ACOR when you have all this data backing that this is as good or likely much better than tafamidis. But let's say they only get 50% of the market share. It's split between TAFA, it's split between ACOR, 50-50 for the first 6 months of the year. And then for the last 6 months of the year, they only get a third. Again, this isn't what's going to happen. They're going to dominate this, okay? So they get a third, and a third, even though they have a superior drug to ALNY, bar none, and they have a superior drug to tafamidis, okay? For the first half of the year, they get 50%. For the second half of the year, they get a third. $2.5 billion for the whole year. We'll call it $1.25 billion for 6 months, okay? That's $600 million they're going to get in the first 6 months and $400 million in the second 6 months, okay? I think they're going to be run rating $1 billion in sales by the end of 2025 just in new patients. If you add that $1 billion to the 600 to up to $2 billion they're going to get from TAFA crossovers, guess what the street's at for 2025? $250 million in sales. Yeah, $250 million. And they're at $500 million for 2026. Okay? You don't usually want to be long a drug company into a launch. But holy shit, these numbers are going to be so much better than what the street is modeling. Okay? It's going to blow it out of the water. Okay? And it's going to be hockey stick shit. You're going to see people changing over from TAF in the first 90 days. Now, interesting thing this guy said on the call yesterday is that the quarterly infusions of ALNY is a detriment to it being adopted, not a feature. It's a bug. He said this because people do not go into the doctor's office every quarter with this disease. He says he sees his patients between 6 and 12, every 6 to 12 months, because people are stable and there's no reason to go in quarterly. He said the quarterly thing makes it much more difficult and harder for him to schedule the infusions. He'll run out of space and time to do it. Okay. But something else that made me think that was interesting. If people only come in every 6 to 12 months, it's going to take all the way through the end of 2025 for people that are on TAFA to go to the doctor, hear about this new drug, and potentially switch over. So it won't all happen in the first 3 months. It'll happen over the course of November 30th, 2024 to November 30th, 2025. But it's going to happen, and it's going to happen very aggressively. Okay. And you tell me what the stock does if they start putting up sales numbers like that. Okay. You then have 3 phase 3 readouts next year. And those 3 phase 3 readouts are highly likely to be positive based on the phase 2 data and the biomarkers that are going to be associated with approval, at least on one of them. The other 2 are clinical endpoints, but again, very likely to be approved based on what the strong phase 2 data. What are those worth? Well, combined, those 3 drugs should offer something like a peak sales of $2 billion, probably even more if whatever that name is, achondroplasia gets is successful in another indication that's currently enrolling now. If we use $2 billion and we use 4 times peak sales, that's an $8 billion valuation exiting next year if all 3 are successful. Okay, I'll risk adjust that today to $3 to $4 billion. Okay, what is Acor worth? Well, let's talk about the elephant in the room: the 2028 Pfizer patents. Okay, this to me is all smoke and mirrors. That is completely irrelevant today. Okay, we will have 3+ years of blockbuster sales before that ever happens, if it happens. And if it does happen in 2028, at that point, Acor could be doing 5, 6, 7 billion in sales. Okay. And it's very unlikely that the incumbent base would switch over to generic Tafa if they're already on Acor. Okay. But what about combo therapy? Again, I think it's completely overblown. Okay, there's going to be a readout in 2026 with AZN, and it's likely that they hit stat sig on mortality in the combo therapy. But will it be enough to matter versus how good the BBIO data already is? And I think the answer is going to be no. It's going to show similar efficacy to what Acor shows. And if you have a twice-a-day pill that shows similar efficacy, why on earth do you need to do 2 different therapies, even if one's generic, and take on the additional risks of side effects with 2 different therapies? And again, this would be 2028 at the earliest anyway. But I don't even think it's going to go generic in 2028. Okay? There's lots of reasons to believe that Pfizer is going to defend this aggressively, and it's going to go well into the 2030s before we have to worry about that. But this is completely irrelevant to the stock price over the next 12 months. Okay, a lot of bears think it's going to trade at a very low multiple because of this LOE in 2028. And I just don't see it. Now, there's another nugget that might happen in the next 6 months. Now that this ALNY data is out, I think that there is a decent chance, at least 50%, that they sell the drug outright to Big Pharma or they co-promote it 50-50. Why would they do this? Well, the cost of capital of Big Pharma and the diversification of risk, the 2028 LOE risk and the 2026 AZN readout, is obviously much greater for BridgeBio than it is for a big diversified pharmaceutical company. Any way you look at it, value can be added by this asset being moved off BridgeBio's balance sheet and onto somebody else's balance sheet. Everybody wins, okay? And you also can compete better with Pfizer and ALNY in the marketplace if you have deep-pocketed big pharma selling this drug. Now, I wouldn't say it's my base case, but I think there's a 50% chance of this happening. And what would that look like? So in either case, either a co-promote or a full sale, I can't come up with Acor being worth less than $10 billion, risk adjusted for the 2028 LOE. I think you'll get 10 billion of sales cumulative between now and 2028 anyway. Now, of course, you have to pay for a sales force, but if you get 10 billion of cumulative sales between now and 2028, and then you also get the tail end of all the installed base of people that are on the drug, even if LOE happens, it's worth more than 10 billion, right? But I'm going to go with 10 billion, okay? And if it's worth 10 billion today, either through a co-promote or through a full sale, and the pipe is worth 3 to 4 billion today, and you have 1 billion of net debt, okay, that gets you to a $60 to $70 stock price, $60 to $65 stock price today. The stock is $29.70, okay? The amount of ways you have to be wrong to lose money here, to me, is astronomical. Okay, first of all, you probably need some sort of side effect to happen in Acor to where the drug is deemed, off market, can't be used. It's been tested in like 1,000 patients or whatever, 500 patients, and the odds of that happening are almost zero. Okay, you would probably need something bad to happen with the IP, the 2028 IP, in the near term. For, again, I don't think you'd even be impaired from $30, just that it wouldn't go up to $60. Again, I don't see how that could happen. Okay. If something happened with their lead phase 3 product in the drug that's competing with BioMarin, again, I don't know how to say the name of the disease, the stock would definitely go down on that. That's, though, almost fully enrolled. And if there was a side effect issue there or something going on, I think we would already know about that. Neil said today they're not raising any more capital, so you're not going to have a secondary offering coming in the coming days. I think the odds of a problem with the FDA review are near zero, but that, of course, would crush the stock if that happened. I don't think I'm leaving out anything else. I think fair value today is well into the 40s. It's really $60. And I think as you approach the end of next year, if you have between 1 and 2 billion, if you're run rating between 1 and 2 billion in sales versus the street at 250, street's at 250 for the full year, not run rating, but they're at 500 million for 2026. So clearly they're not having a run rate above 3 or 350 by the end of 2025. If you're between 1 and 2 billion of sales, if you have those phase 3s read out positively, easily can be at an $18 billion enterprise value, okay, which gets you to $85 a share by the end of next year versus $29.66 today. Couldn't be more enthused about BridgeBio. I have not sold any stock. It's a 73% delta adjusted position for me, 25% common, the rest in call spreads. My biggest call spread position, as I've told you many times, is January 26, 35-55 call spreads. I think today, given how bullish I am on the situation now, you could probably put on 40-60 call spreads instead. The reason why I like the 35-55s was in case we got a shitty takeout price. I think today there's no way this company would be taken out for less than $55 a share. So I just don't see that happening. Yeah. Any questions? No questions? And finding Target Hospitality. There's not much to add from my last very long YouTube that you should go check out. We're just in a waiting mode here. One thing I will say is I saw an article on TDR Capital from a year or 2 years ago, and they listed all the net debt on all their portfolio companies. And every single portfolio company they have was the least amount of net debt they had was 4.5 times levered up to like 9 times levered. Okay. Target Hospitality currently is 0 net leverage. Okay. If they levered it to 4 times on the 165 EBITDA, okay, that gets you to like 650 million in new debt they could take out. 650 million at 4 times leverage. Okay. They need about 400 to 425 million to take this out at 1150. Okay. They would be left with almost 200 million in a revolver to fund all the growth capex they'd ever need for all the projects coming up. And they'd be 4 times levered. Okay. Easily financeable. I still strongly believe, or I believe that this will end up getting sold to a third party based on the change in language from the last press release. And I think we are just with a matter of weeks away from a transaction here. That's my holy grail. The Target Hospitality is obviously my biggest position. That's a 77 or 78% delta adjusted position. Again, about 30% common. The rest just massive call spreads across all these different months. I have nothing, unfortunately, that I like today from a call spread perspective. It really would just be common is where I'm enthused. Yeah. I'm also short a little ALNY, by the way. That pig is bloated. But just to give you a sense of how insane the discrepancy in valuation between ALNY and BridgeBio is, people thought that if the ALNY trial failed, the stock was going to go between $80 and $100 a share, okay? Before today, it was at $280. So I'm going to use that as a metric of what people thought when they thought they had a best-in-class drug in ATTR-CM, okay? I can't remember what the numbers are. I think it's 100 and, hold on one second. Give me 1 second. There's 130 million shares in ALNY outstanding, okay? Difference between 280 and 100 is $180. 180 times 130 is $23 billion in valuation attributed to ATTR-CM. It was not attributed to platform value or any other bullshit. $23 billion ATTR-CM, okay? 23 billion, okay? I'm using 10 billion for my BridgeBio valuation for ATTR-CM. 10 billion, not 20 billion, not 23 billion. And BridgeBio has the best-in-class drug that is going to have a higher market share than ALNY will have. Okay, even here at 250, it's pricing in like a 20 billion or 19 billion valuation for ATTR-CM. The path is clear how this is going to work. BridgeBio is going to get approved. You're going to see hockey stick crazy growth come out of it. And you're going to see BridgeBio re-rate. Might not happen overnight, but we'll be into the high 30s, low 40s, probably by PDUFA, is my guess. That's very interesting. You're asking about MagnaChip. What if I were to tell you that I've been adding to MagnaChip? Because I am a sucker for punishment. This is the MagnaChip math, people. Okay? Right now, today, MagnaChip has $3.95 in current assets minus all liabilities. Every liability and just the current assets, which is cash, inventory, accounts receivable, basically. Okay? $3.90. Okay? If you take the tangible book value of MagnaChip, okay, and you include their value for their deferred tax asset, tangible book value, it's $8.10 versus $4.66 today. Okay. If you don't include the tax asset, which I think you should, it's not an NOL, it's a tax asset on their balance sheet. Take $1 off of it, a little bit more than $1. So you're at $7.10. Okay. But there's a real fucking business at Magnachip. The power business is real. Okay. And the power business is bigger than it was in 2020 or 2021 when there were multiple parties that wanted to pay $200 million for it. Okay. $200 million with 37 million shares outstanding is like $6 a share. That would be above and beyond what you would get the 390 for, the current assets minus all liabilities. And of course, you can't count the PP&E twice because you need that to generate the $200 million for power. But that's not all. You still have OLED, which, yes, it sucks right now, but OLED's worth something. So they're either going to shut it down or they're going to get some Chinese customers. But it's worth something. Now, what's the problem with Magnachip? The problem is that they're burning money, right? They're currently burning between 50 cents and $1 a year, probably. But they're at an inflection point, we hope, right? We're hoping towards the end of this year, it's going to be an inflection point, and they're going to really show growth in 2025. First of all, the transitionary revenue is going to be gone by the end of this year. So you'll have much better comps when you look at it from an apples to apples perspective, 2026 over 2025. Sorry, 2025 over 2024. Somehow Magnachip, this piece of shit company, went from, I believe it was a $27 acquisition or 29. I have such PTSD, I can't even remember. I think it was 27. That over $27 acquisition to a $4.70 stock. Rightfully, when their most important business went to zero and they lost their biggest customer with Samsung. Okay. But it's now trading virtually at its net current assets minus all of its liabilities. It's my belief they could shut the fucking company down. That includes, by the way, severance, accrued severance and retirement funds for employees. That's on the liability side. They could shut the company down, sell the PP&E, obviously get something for the power business that's doing whatever, 200 million a year in sales. I think it's doing even more than that. Hold on. I actually meant to look this up. I forgot to do it. Power last year had a bad year. Again, that's the reason why the stock is where it is. And Power did 163 million last year, okay? And it's supposed to grow by double digit this year. So it did 230 in 2022. So whatever. Power's 160 to 180 million business. I think it did 160 or 170 when they were getting bids for it in 2020. Same size business as it is today. Okay. I don't know what it's worth, but you've never had a time where your margin of safety in Magnachip could be any wider. Okay. That's just a fact. Well, of course, it's the lowest it's ever been, basically. But I'm pretty sensitive to my value in Magnachip. If the stock was 6, you wouldn't hear me screaming from the rooftops, gotta own Magnachip. Okay. But because of the massive balance sheet it has, there's a lot of sensitivity between 460 and 6. In fact, one trick I like to do is pretend that the stock is 10 times its price because it makes it seem more pronounced, the difference between 460 and 6. If it was a $46 stock down from 60, you might think, wow, that's a pretty big pullback, right? It doesn't seem as pronounced when it's a $6 stock trading at 460. But it is. It's a big difference, especially when you're looking at it from an enterprise value perspective. And what's the final kicker with Magnachip? The company's still actively buying back stock. They're doing it slower, but they did it last quarter, and they did it in post quarter end in the 10Q, you could see it. Now, they're not buying back stock in a very, very aggressive manner, but it's still happening. And it's incredibly accretive to, if you think this is worth $8 to $10 a share, which I do, then every stock they could buy below 5, they're getting 50 cents on the dollar. How come AONY is holding up so well? Bulls in denial. It's a very different kind of company. It's owned by a ton of long-only shops, apparently, and they love the company. They love the platform behind it. I couldn't tell you really why it's still 250. I think it will take time and it will slowly go down. Obviously, I like BBIO as a long 15 times better than I like AONY as a short, but I am short like a 5% position in AONY. I would not even blink in surprise. Oh, at MX, LOL sucker punishment. I love it when you talk about the last bids. Yeah, I know. It's very depressing. Wow, a lot of views this time. I know. I'm up to 43, baby. Thanks, guys and girls. Though I'm not sure I've ever had a girl on my YouTube. I do have, I think, at least 2 female Twitter followers. I welcome the ladies. Talking margin of safety cash. Do you think of buying back some Cure here in the 5s? Great question. No. I am very disappointed with Cure management. I consider that I was bailed out there, and it's currently a 3% position, Unicure. That's it, 3%. And I might be tempted in the 3s or early low 4s, maybe. But no, I've moved on from Unicure. Yeah. Where are my insider buys? Both the chairman and the CEO told me that when the window opens up, they're right there. They can't believe how cheap the stock is. Well, the strategic process is probably over. They reported the data in Huntington's. There's no way they're in a blackout period. Okay. If they're in a blackout period, they're selling the company. So if the company gets sold, great. I still own, by the way, 10-15 call spreads in Jan 25 and Jan 26. Together, they're less than 50 basis points of my capital. So they're very small, but they'll go up 10x if they get made whole. So, bring on a sale. If this gets sold, it should get sold for $15, based on the fact they have $8 in cash. No, I feel pretty bailed out with Unicure. I do. Yeah. I went in real big there, and I wasn't greedy. I hit bids all the way from day one after they reported the HD data, and I took it down significantly as the days went on. CYTK, I have a 2.5% common position, and I own Jan 26, 75, 85 call spreads, and that's like 100 basis point position. I don't know enough about it to really opine. I really follow the goats of Twitter, Sheep and Sport, and they both own it, publicly disclosed. They think it's a best-in-class drug, and I think that it's a decent chance come January 2026, the company sold, or we see a really good ramp in sales there, and maybe some good news on the REMS front when it gets approved, and the stock is above $85, which is why I put on those call spreads. But I don't know enough about it or care enough about it to make it a big common position, at least not right now. I massively prefer BBIO for all the reasons I've outlined. Looks like you're drinking a gallon of chocolate milk. How big is that glass? This is a smoothie, and I don't know, it's like 32 ounces, I think. Thank you for the question, Glenn. CYTK also case of shitty management. Yeah, I don't know what to make there about the management team. Obviously, people are pretty pissed the way they handled the buyout process, but the way the facts have come up, I'm not so sure it's their fault that they didn't get the deal from Novartis. I tend to side with them, that they're being transparent and that they are interested in the deal, and that Novartis just walked. So I think they kind of got a bad rap. And everyone's so pissed off they're running that phase 3 trial in whatever drug or indication. I don't even know what that is. I don't think that matters that much, quite frankly. Anything else? My biggest positions, besides TH and BBIO, it drops off dramatically. It's AMPY and Magnachip. I own like 17, 16, 18% delta adjusted in both of those. And then it falls off. Roivant is much smaller now. That's like an 8% delta adjusted position. Munivant is like a 6.5% delta adjusted position. Wild Open West is like a 7% position. I've never really talked about that in detail. That's a classic majority minority buyout, though it's a little different because the 40% owner is not adding any new money. Andrew Walker has done a ton of work on this. You can go read his blog on it and his blog posts on it. And there's no reason for me to even discuss it. But it's a levered equity stub, and it could go for significantly more than it's trading at. But I don't have enough conviction to make it bigger than the 7% that it is. I think that's everything. EDR, I still own a ton of November calls and Jan calls. I'll probably exercise those to keep the common and roll it for the lawsuits when the time comes. As of now, I'm not going to do appraisal in EDR, but I think appraisal is very interesting. And I'm not going to talk about it much because I'm probably not going to do it. And it's not really something that the average person can do. So it's not really important to bring up. But the post-close lawsuits, they're going to be incredible. TKO is, 119 right now. All right. Thank you, everybody. Let's get this TH deal and let's go to Vegas. Take care. Oh, any learnings about your long-term, I can't read that. Any learnings about your long-term P&L reflection, for example, on sizing? I mean, look, in the past few years, all of my, 80, 90, 100% delta adjusted positions have all worked. So most recently they were EDR and they were Alteryx. In the past, they were Dell, DVMT. I had huge positions in SHLX, huge positions in CNR, huge positions in DCP. These are all majority minority takeouts. The way I structure this stuff is I try to lean in on call spreads so that I can make these things as big as they are. Because they can't have a common position at 75, 80%, okay? I'm comfortable in all of these cases to take a one-day loss of 20% of my portfolio. If I lose 20% of my portfolio, after tax, that's a 10% loss. And I have now, luckily, knock on wood, plenty of taxes to pay in the future. And I'm personally comfortable with that. But there's people that should be sized and are sized 1/10 the size that I am in all these names, right? A 7% position is sometimes the biggest position anyone's ever had in their lives. So it really just has to do with what your risk tolerance is. Most people's risk tolerance isn't what mine is. So do I think it's normal or acceptable to have positions of 70, 80% delta adjusted? No, I don't think people should be having positions that big. And to follow up with your question is, at what point, Wealth, do I stop making these massive bets? I don't want to jinx myself, but this might be the end of it this year. If Target works out, that will come off. And then the only one left on there is BridgeBio. And BridgeBio is mostly, long-term call spreads. And it's obviously a lot of common too. I don't see myself aggressively cutting that until the mid to high 30s, or even cutting it. I don't know when I'm going to start making my first sale there. But I don't think I'll put on new positions greater than 50% going forward. I just hate to say never, because if you have an EDR-like situation, I looked at EDR as very low risk. So if I can structure it right with the right call spreads to where I'm 20%, 25% common, and I put on a call spread position where I risk 1,000 basis points or 1,500 basis points. And if it doesn't work, they don't go to zero. Maybe they're long dated, like I had with Nordstrom. and with Target. A lot of my Target hospitality call spreads are Jan 26. So I don't expect them to go to zero unless, they lose Picos. I might still be comfortable doing that in the coming years, but it would have to be in like an EDR-like thing, not like Alteryx and not like BridgeBio. Certainly not Unicure, right? But like Magnachip, could Magnachip be 30, 35% at this level? If I had the capacity, and it definitely could be 30, 35%, right? I don't see a situation where the company runs Magnachip into zero. Okay. The board is aligned. The CEO is aligned. I think they would shut the company down or sell it for scraps, by the end of 2025 if they don't make any progress on OLED versus just burning the cash to zero. So, but it's a great question. And I'm not superstitious, and Target Hospitality is far from a done deal. Okay. There's definitely risk there. They lost the daily contract. They could lose Picos. I don't think they will. That's clearly a game over for the company if they do. There is no victory lap there until that deal is signed. With Nordstrom, I think it was significantly de-risked today. Again, no victory lap till it's signed. But if I was at 75% going in today, I'm now at 90% with Nordstrom. I simply just don't see how they don't get a deal done. The bid ask is probably within $1 or $2 of where it's trading. And everybody is aligned to get a deal done, from the special committee to all the advisors to shareholders. So, yeah. All right. Let's do this, guys. Let's end this year well. Take care, everybody.